I've always been saving and investing everything that I could since I was a kid. I graduated at about 21 years old. I started working, and then at 22, I ended up purchasing my first apartment in Berlin. Wealthy individuals have been investing into these assets for hundreds of years, but they are not accessible to the average individual. We allow anyone within the European Union to invest in alternative assets that were previously only available to high net worth individuals. So watches, wine, whiskey, cars.
Welcome to Value Add, your edge in building wealth.
Hello, everyone. Today we're here with Ioana, CEO of Konvi. It's an investment platform that allows you to invest in exotic assets such as watches, wines, etc. Hey, Ioana.
Hi, thanks for having me and glad to be here. So to quickly introduce myself, I am the CEO of Konvi. We allow anyone within the European Union to invest in alternative assets that were previously only available to high net worth individuals. So we are talking about watches, wine, whiskey, cars. Very soon we'll have art. So really the assets that have very high entry barriers, but now through the asset managers that we work with, we can bring them to retail investors. We've launched just over a year ago, so we are still very new. But we have onboarded on our platform already 30,000 users. They invest in us through the asset manager, so they don't invest in Konvi by itself. We are just the platform that connects the two. And we are seeing great interest over the past months, especially with the high interest rate environment happening at the moment, which is beneficial to alternative assets.
Wow, that's super cool. So yeah, you mentioned some very cool assets over there for watches, wines, whiskeys, and then cars as well. So how did you get into investing, or I guess creating a platform for investing in such assets? Were you investing yourself previously? Tell us maybe a little bit about your background and how you got into it.
So personally, yes, I've always been saving and investing everything that I could since I was a kid. I've saved money. Even when my parents gave me a budget, I was saving part of it. So it was kind of part of the way I've always thought about money, allocating a part of whatever I earn towards savings. So naturally, the second I've managed to get any significant income, I've put it towards investments. My initial goal was actually quite large for someone my age. So I graduated at about 21 years old from Computer Science University. I started working, and then at 22, I ended up purchasing my first apartment in Berlin. That gave me the financial freedom that I wanted to, in terms of I didn't have to pay rent to someone else anymore. So I had also the ability to tell myself that I will diversify now into other asset classes. So that's what led me to more, I'd say, less known alternative assets. Initially, after real estate, I, of course, have done the basics that every investor does. So allocating a certain amount of my income to public markets, specifically ETFs. After that, I've looked into P2P loans in terms of alternatives, and also into crypto, not so much, as I'm, say, more risk averse compared to a regular crypto user. But then within my process, me and my co-founder, which is also my husband, we started a discussion about exotic assets, what you call art, watches, wine. High net worth individuals, wealthy individuals have been investing into these assets for hundreds of years, but they are not accessible to the average individual. And why is that? We didn't know, because if you're looking at equities, we've seen the democratization of public markets, Robinhood. This totally disrupted the market over the past 10 years. We believe that there was the time for someone to do this for alternative assets, exotic assets specifically. So that's how we've ended up building a platform that facilitate these transactions. But we knew that we are not able to provide these assets ourselves. And that's where we decided on the marketplace model.
That's super cool, because to me, alternates are always interesting because, one, they have very interesting characteristics from an investment standpoint. As you mentioned, right? They've been high performing, only accessible by high net worth individuals. or the ultra rich, but also they're super cool assets that we actually use and that we use in our maybe daily lives or aspire to have at some point of time, whether we consume them in the form of like wine or we wear a watch. I feel like there's a niche of people who, outside of high net worth individuals, who also just have had interest in these specific assets as, let's say, like a hobby or something, and then might have figured it out as well that, okay, these might be good investments. So just diving a little bit deeper into that, these are very interesting assets. How does one think about valuing such assets? How do I know that this watch is going to perform well, or this wine is going to perform well, this whiskey is going to perform well, this car is going to appreciate? Cars in general are depreciating assets, right? So like, how do you go about thinking about this market? Because if I compare it to stocks, you have a fundamental language that everyone's talking. Your financial statements, you can compare different companies in the same industry. You can figure out what future cash flows might be from these companies. Those are typically either comparisons or discount cash flows that you use to figure out the values of these companies. So how do you think about investing in exotic goods?
Well, from my point of view, and I think anyone that is working in the industry will agree on this point, the market is really opaque. So it is much harder to value a good that is sold privately than it is to evaluate a public company, since you do not have the data that you may have when it comes to public markets. Now, you made the comparison to companies. I must mention that this is very similar to what we do. So if you come from the public markets, I would suggest thinking of one good as one company. At the end of the day, similar items, which could be companies, they increase in value as well. So you can see price fluctuations over the time for certain pieces, say a piece of art, or the Patek Philippe Nautilus, for example, a watch that is very popular and has been produced for decades, or the Hermès Birkin, which has price history over 35 years old. I do not know the up-to-date data, but last year, the average year-over-year appreciation over the past 35 years was 14.2% per year. So you can look into this data. However, 99% of luxury items are not investments, are not in what you'd call investment grade. So that's the issue here, where if you're not an expert and know the market really, really well, you can fail much faster than on the public markets. There's not much of a crowd that you can follow, which of course you shouldn't follow a crowd, public markets either, but I hope you understand what I mean.
Yeah.
So yeah, that's how I see valuation. Because it's so opaque, I believe that there should be an expert that really understands one specific asset category. So say watches or whiskey. That expert, because one, they have the connections within the industry to get the data and the negotiation power within the industry because of their connections. They're able to both buy and sell the best investment opportunities. Actually, there's a lot of people that do that. So the first art fund, as a fun fact, was created in the 1900s, either late 1800s or beginning of 1900s, where a couple people have decided to pull their money together and buy and sell art for investment. Then they started bringing other people around them. I believe personally that that's the way to go. You can see companies in the industry that purchase and sell assets themselves. But when you do that, when you sell the asset yourself, you end up going through a third party. So for example, an auction house, to which you could pay 20 to 40% of the sale price, which is considered ridiculous, right? When you're thinking about investments for retail investors. So we generally work with one expert for one asset class that has the right connections to avoid these third-party fees.
Got it. That's super interesting. I think you touched on this a little bit. So in terms of historical returns, right, what have you seen across the different asset classes? Maybe we talk a little bit about what's happening in the market right now as well. You mentioned high interest rate environment right now is actually beneficial for you. Maybe we can talk a little bit about why that is. And so where I'm getting at is if we can touch on what do you see in long-term historical returns be, how you've seen the market perform since you started. I think you started like mid-COVID, if I'm not mistaken, and then how that's evolved over the last 3 years, because the last 2 years each year has been kind of crazy in its own ways.
So in terms of historical returns, each asset class has a longer or shorter history, depending of how long have people been publicly sharing that they've been investing into these assets. So we know specific items within industries that have been performing really well that people are always watching. I mentioned Hermès Birkin from Hermès, Hermès Kelly handbag from Hermès. There's a couple pieces from Patek Philippe for watches, Rolexes, and so on and so forth. Those are all great examples of double-digit appreciation. So, of course, those are not the benchmarks of the industry, but they are there. Then there's also asset category specific return. They can differ depending on where you get your data from, because we can look into the European market, in the US market, worldwide. Now, we do see overall that what you'd call investment grade watches over $50,000 can get to double digit appreciation, but as part of the industry standard, we'd see watches comparable to public markets, so 7 to 8%. That's where having your asset manager that's able to outperform that is super important. So for example, Watch Fund, our partner, has historically seen 20% per annum with their 60 million in assets under management. For wine, it is a high single-digit appreciation. Again, it also depends on the supplier. So, for example, we work with the 2 wine suppliers. One advertises historically 8% yearly average appreciation, and one an 11% yearly average appreciation. So it depends on the region and connections. I'd say the way you choose investing in these asset classes, first of all, you'd look on whether they are comparable with public markets, because at the end of the day, you want to build a diversified portfolio that outperforms public markets and or has less volatility. So when investing in alternative assets and exotic assets in general, you'd be looking at investing in a couple different alternative assets that perform differently, uncorrelated. So wine versus watches versus art are good, I'd say, diversification tool together, because, for example, wine has medium volatility, but high single-digit returns. Art has double-digit returns, but it's more volatile and it's cyclical to the markets. Then watches and jewelry are considered the store of value, so they are low volatility. There's other, I'd say, less known assets. For example, a recent report from Deloitte mentioned that Chinese pottery is also a store of value, but not everyone wants to venture there yet.
That's a lot of great information. I think that's a good segue to understand a little more about Konvi. So I believe you guys started off with watches. So how did that come about? You said you have to have partnerships with the experts in the space. How did you come across the experts from a watch perspective? Why was watches the first asset that you provided access to?
So there were multiple reasons. We believe that there was a gap in the market. There was no one that was focusing on watches as their main first asset class. If you look in the US, the main 2 players were focusing on art and initially cars or playing cards. Then on the European market, watches are very interesting because all the watch producers are here, Swiss, and some of them, like Glashütte in Germany. I hope I didn't pronounce it wrong. One, in terms of the adoption, we believe that it would be one of the cheapest ones from the customer's perspective. But then secondly, we've been lucky to stumble across Watch Fund. So we've spoken to a couple suppliers, but Watch Fund had the highest historical appreciation and the lowest risk in terms of their lowest appreciation and risk of failure. So we've decided to start our marketing with watches, but we've always tried to incorporate the concept of diversification in everything we've done. Actually, the way it works when you invest on Konvi, You don't invest in a watch you know of. You invest in, for example, a funding project, a crowdfunding project that will pull people together. When the funding project is finalized, then they know what watch will be purchased.
Okay.
Which means that our customers invest in the asset class and in the potential of watches and watch fund for watches specifically. So then when we introduce new asset classes, for example, wine with cold wines, our customers were quite keen to continue diversifying because that's why they come to Konvi, to diversify and to get access to asset managers. That's where, even though they come for the love of either wine or watches, they stay because they're investors. They're not traders.
That makes a lot of sense. So, what is your typical investor profile and what are your minimum investment amounts?
So, our typical investor profile is, first of all, we have investors coming from all over the EU. We are lucky to have acquired a license that allows us to operate all over Europe. That's a huge advantage of ours because we only have direct competition in few markets in Europe, local markets. But we do see a lot of interest coming from France specifically when it comes to all asset classes. And we've landed on this market following experimentation on the marketing perspective. In terms of their interest and why they come to Konvi, as I mentioned, they come for diversification, which is really interesting. Yep. You would expect that our customers come because they love watches and they just want to say that they own a piece of a watch. Of course, that's nice. As you said, the pleasure part of it is really cool. It's nicer to say that you own 1% of the third most expensive Cartier in the world than say that you own $10 in Tesla. But yes, they come for diversification. They are generally medium to long-term investors because you asked, and now I will touch base on the appreciation period. Whenever they invest in Konvi, the funding projects have on average 3 to 5 year appreciation period, which means that their funds are currently locked for that period of time, and then the proceeds come back to them when the appreciation period ends, and then the item is sold to a collector. So because they are mid to long-term investors, that means that they also invest on a regular basis. So you expect our average customer to invest at least twice a year after they get onboarded. And because our minimum investment is not so small, so that was another question. Our minimum investment is 250 euro. Because of the 250 euro minimum investment, we bring customers on the platform that want to integrate alternative assets in their overall investment strategy. So they are not putting in their play money, they're actually allocating every month to alternative assets, and they've chosen Konvi as their platform for it.
Interesting. So you talked about minimum investments. Your average customer, how much do they invest?
So on average, including the users who signed up yesterday, is currently about 1,300 euro per customer in a portfolio. But of course, we expect that to grow a lot more over the next years as our current customers continue investing with us.
Got it. One of my favorite things about these platforms is it provides more accessibility, right? So as you mentioned, these are very, very expensive assets. You said 250 is a slightly high number, but actually it's relatively low compared to what someone would actually have to pay. So you're just priced out of the market completely.
Yeah, of course.
You don't necessarily have access to it at all. My next question is, in terms of investors making money, I think you talked about it. I assume it's mainly appreciation. You said it's a 5-year appreciation period, after which you typically sell the assets, investors get their money back. Is there any other way people are making money off of it? Is there like a secondary market that you provide access to for people to trade their shares of, for example, a Cartier watch?
So currently the appreciation period is fixed, meaning that our customers are locked for that period of time. However, we are planning of releasing a version of a secondary market very soon in the form of a bulletin board. So we have that feature approved within the regulation. So we plan to release it within the next few months. And we are curious to see how much interest we'll receive from such a feature, as our customers haven't asked for it specifically too much yet.
Interesting. Yeah, so because then that starts operating, and one, it's great because you provide more liquidity in case someone needs to pull out cash for some emergency. But I think the risk is, and I've been thinking about this a little bit, but public markets work the way they do because they have that liquidity. So if there's a shock in the market, whether it's a boom or a bust, it happens instantaneously because you're able to trade in and out as soon as possible. One of the benefits of private markets for me is that it's actually not as liquid. So it's not susceptible to the shocks that the public markets face. Over time, they will have maybe some kind of correction or some kind of outperformance, but it's a longer period of time. That's kind of what I've seen. So I'd be very interested to see what happens with that bulletin feature, although I do like the idea because I think providing liquidity options to people is a good option. So I guess my next question is, so how does Konvi make money?
Yes, so we charge both the customers and the suppliers, which are the asset managers. Then from the customer side, we have two direct fees that are optional. So we charge a 1% payment fee if you decide to pay via credit card. If you pay by SEPA, then it is totally free. Then we charge another 1% whenever a portfolio is less than 2,000 euro after the purchase. So those two fees will be added at checkout. So in the case you invest 1,000 euro and decide to invest via credit card and have not yet reached 2K, you'll pay 1,020.
Do a lot of people use credit card?
Over a third, actually. I
Over a
wouldn't
third,
expect that, but yes, it's always good to have the option, better for conversion.
Yeah, that's very interesting because then essentially they're leveraged, right? So you touched on you are a regulated entity. Can you talk a little bit more about that? What does the regulation include? How are you in compliance?
Yes, so we are regulated by the Central Bank of Ireland. We first acquired a regulation for AML purposes, so anti-money laundering, and that was in 2021. Then in November 2021, a new law was put into force onto the European market for crowdfunding services. So because we have been operating, we have received the crowdfunding service provider provisional authorization. We are in the process of obtaining the full authorization, as all the platforms in Europe that were operating under crowdfunding, many of them are still to be reviewed by their own jurisdiction, their monetary government from that jurisdiction. This regulation has the unique ability to allow us to passport this license all over the EEA region. And that's why we operate in over 30 countries. It is quite difficult to implement, especially if you have not had our opportunity to obtain the provisional authorization first. It's extremely difficult to understand how to set up your business around this regulation. In our specific case, because we have been operating beforehand, we had the opportunity to liaise with the Irish government for over a year and adapt our business to what they need. But we are actually the only business in Europe that comes under the crowdfunding regulation with this application of luxury items, which means that we do hold an IP that we are proud of, that other companies, of course, would have difficulties to get. So most of our competition in Europe adheres to local laws, some linked to crypto, which we decided against on. Then in the US market, they are regulated with the SEC, Security and Exchange Commission, and operate in a more similar way with Konvi. So I don't know if I should get more into detail about how we protect the customers, but then from a regulatory perspective, if you look at both Konvi, us, and the US counterparts, for each investment that appears on the platform, there is one company, a holding company, that holds one asset. What is different from our side, this company, these single purpose vehicles called from a legal perspective, SPVs, in Konvi's case, they are not owned by Konvi. So they are completely independent, which means that they have a separate directorship. The customers have voted in the rules themselves. And whatever happens to Konvi, the holding entity is not affected. So, in the least likely scenario, the holding companies are protected from any potential insolvencies.
So it sounds like you don't have any direct competitors. I assume you have competitors in local markets, and then you have just general exotic asset funds would be your competitors as well. Interesting. So I guess my next question is, looking at the market, I haven't looked at watches specifically, but I've looked at wine and I've looked at some other exotic assets. Over the past year and a half, since interest rates have started going up, the value of these assets have also skyrocketed. And I think it's an atypical return that you've probably seen in the last year and a half. Is that what you've seen across the board, across the exotic assets that you've been looking at? And then what is your future outlook for such assets, given the high appreciation that they might have had over the last year?
So I would be wary of onboarding a supplier, an asset manager that expects the same returns that they've seen in 2021. Every supplier that we work with, they work with the long-term thinking. So they know that once the asset has been appreciating for, say, 3 to 5 years, there is this expectation in an average scenario. If it is for some of our assets to skyrocket, the ones purchased in 2021 and 2022, amazing. But we will not change our partners' historical performance just because they've had one good year. For example, Colt Wine spans over 20 years of data, Watch Fund as the entity 10 years, and then 23 through the CEO. So we are looking at strong data that went already through another financial crisis in 2008. Those are our favorite type of partners. Now, if they are younger, we'll of course share that with our community. And we invite our customers to decide whether this is in line with their risk appetite.
Awesome. That was a lot of great information. We learned a lot about the market of exotic assets investing. I'd like to touch a little bit on a few more topics. So one is your founder journey. You mentioned that you started this company with your husband. One, let's talk about the founder journey. How was that from idea to actually getting the company incorporated and getting the conviction that this is a real business? But two, also starting it with your husband, right? Like there's a whole aspect there that a lot of people talk about, don't mix business with pleasure. So I'm just curious to know, since you mentioned that.
Yeah, so fun fact, we incorporate companies whenever we have the idea, just because we know the risks of IP law and holding certain assets personally, moving them under the company is a huge pain and you don't want to deal with it. Let's just say we've incorporated way too many companies than we should compared to a regular person. So we've actually just incorporated whenever we've decided that we want to do this. Now, in terms of the journey, it's a long story, and I don't think we have time to go through the entire story. But if we want to touch base on some points within our journey, I'd say our biggest difficulty to launch was the regulatory side of things. The blessing that we've had was that when we've started this, we knew nothing about this world. And because we were like babies within the financial space, we've decided to do it because we're in it, we continued. But that's also why many people that are very experienced in the space decide this is not worth it. Because we're talking about a business that incorporates a company for every asset worth 100,000 euro that is bought. So we have currently 12 companies that we've supported to incorporate. We don't direct them, but we are there, Then the Konvi group doesn't have a very simple legal structure either. On top of that, it comes with the regulatory monitoring of multiple licenses. So we've been through the application of 3 licenses. Not fun. So the biggest learning we've had out of this part was that we needed upfront capital. So we've put in a lot of our personal funds to pay lawyers in before we've managed to raise the first investment into the company, because there was no way to an MVP without paying lawyers, which me as a ex-software engineer was very difficult, that we've had to deal with all these external parties that we couldn't control and would cost a lot of money. So we've adapted to that. We've worked now with people from very different industries. And luckily, as part of this journey, I've learned a lot about incorporating companies. I find it quite interesting. I can now change some contract clauses if I need to. I can probably figure out the tax situation of every startup and at least direct them to the right person. So if you do have a startup that you want to incorporate, feel free to hit me up and I can help you. Your second question was the founder side, right? So yes, we are married. We weren't married when we started, but we've been dating for 7 years before we got married. So it wasn't a new relationship that we didn't know how to navigate. We've been through some tough, say, challenges years before, and we knew over time what we need to do in order to work together well. For us, the most difficult part was that, well, because we are both into this business, we put everything first. The business is always first. So there's always company discussions at home, at dinner. I don't care because it's exciting, right? But you cannot do this forever. Then on the bright side, when things are bad, they're bad for both of us. When things are good, they're good for both of us. So if we cannot go in vacation, we cannot go in vacation. There's no fight about that, right? So in that sense, it's really good. Also, it's really hard to find very good people to work with. And he's a really smart person. I believe he'd say the same about me, because we've managed to build complementary skills, even though we're both ex-software developers. I've managed to build skills around product, data, finances, just building a business. And on his side, legal, accounting, and everything that I didn't handle. For example, corporate structuring, he handled all of that. We now can build any business from scratch if we want to, and I wouldn't choose anyone else to start with.
That's awesome. It sounds like one, it was an amazing learning journey for both of you, right? From the different skills that you've acquired. At the same time, it's been a fulfilling journey. You both enjoy what you're doing. And kudos to you to keep going in such a regulated industry with so many different hurdles, as you mentioned. You weren't able to come up with an MVP without actually getting all the legal due diligence done. So again, kudos to you. Last question. Now that one, you mentioned you started off as a regular investor in public markets and how you branched off into exotic investments. You've obviously learned a lot of things along the way. What advice would you give someone just starting out as an investor?
So my first advice would be to make sure that you have a clear plan of how you want to invest, what are your financial goals. So from my point of view, I wanted to save everything I could to purchase a property so that I don't have to pay rent, so I can invest in my own future. But this was a very risky decision to make. So I think it depends on what risk you're willing to take that will help you decide what to invest in first. What's important, first of all, would be to have an emergency fund regardless. I'd get that sorted out first. If that is sorted out, then probably the no-brainer decision that every CFA, no financial advice here from my side, just as a disclaimer, would be to go into public markets first, and that would be ETFs. S&P 500, $1,000 a month for 22 years makes an average a millionaire. You can totally just go that route. If you want passive investment, this is perfect. Now, if you want active investments, there's a lot of options out there. The alternative investment market is very broad and is broadening every day. We've seen startup investments that are active as angel investors, or you can invest in equity crowdfunding. There's P2P loans, which I thought were very interesting because we are talking about fixed income. Then exotic assets, I believe, that have a space in there. So you see that high net worth individuals now allocate 5% or maybe more even to exotic assets, besides their private equity investments, their real estate, and so on and so forth. The alternative investment pool keeps growing. But if you have your public markets allocation set up in a portfolio, then you would start thinking about portfolio allocation and how to build your portfolio in order to fit your goals. You can see that the recommendation has been changing over the past years. I don't know if you are familiar with the recent report from KKR, who have started recommending the 40-30-30 portfolio instead of the 60-40 portfolio. The 60-40 portfolio is the traditional 60% equity, 40% allocation. But now KKR has been pushing since last year 40% into equities, 30% into bonds, and 30% into alternatives. On an overall scenario, not only it brings high returns, especially in volatile markets, it can bring high returns, but also it's lower volatility than the traditional portfolio. Now, what alternative investments is? Of course, I will put exotic assets first into the list because build Konvi, but there's exotic assets, there's real estate, there's infrastructure, there's private debt, private equity, secondaries, and so on and so forth. The world is endless. I believe that there is a space for every retail investor into the alternative market, thanks to all the platforms that are picking in here and there. Private equity, private debt, more difficult. It's not for everyone, not for people who don't know about the market. But now we see alternative assets as exotics, crypto, and so on that are a great option out there.
I love that you brought up the KKR study. I was looking at it as well, and I think you're absolutely right. That's what drew me to alternate investments. One, the market was changing course, but two, it's very, very evident that the 60-40 portfolio split is no longer good enough. When things go bad, the stock market and bond market start having more correlation. So having exposure to private markets through alternatives, I think, is necessary. There's a place for alternatives. As you mentioned, even like real estate is an alternative, but also luxury or exotic assets. There's a place for each of these assets in any portfolio. Historically, this was only available to the ultra high net worth people because of the high initial investment amounts. But now there's north of 100 platforms, at least now, that provide you access to alternate investments across the world. So I'm very bullish on the space. I'm very bullish for people, for retail investors as they grow and educate themselves and mature as investors. They understand and actually have more access to these kind of portfolios. So with that, I'm going to wrap up. So thanks a lot again for your time. This was absolutely great. Investing in exotic assets through Konvi. If you're in the EU, you should definitely check them out. Again, Ioana, thanks a lot for your time, and I hope you have a wonderful day.
Thank you for having me and great discussion. Have a great day.
And that's today's value add. If you liked today's episode, hit that like and subscribe button. For long-form written content, subscribe to my newsletter. Otherwise, say hello on Twitter. See you there.